Hi, folks. I'm going to leave my video off. I can tell it's going to be one of those days, and my cable provider is kind of screwing up my broadband. So if my slides stop working, let me know if my audio starts to get weird, because it's not me, it's the broadband. Are there any questions before we start? I was reminded in the corporate finance class that we have no class on Monday. That completely slipped my mind. So there's no class on Monday, which means our next class will be a week from today. And technically, I know I've got reminders from the dean and from the university that this weekend I am supposed to leave you alone. And I will. I won't send you emails. But if you're way behind on your project, I know this weekend is supposed to be a quiet weekend and you're supposed to do whatever you do on quiet weekends. But if you're way behind, I mean, this is, we have only a couple more weekends before this class ends. So I'm just going to let you make the choice on what you want to do with your weekend. Okay? So today we're going to talk about private company valuation. Right? And because so far every company we valued has been a publicly traded company, right? Whether big or small, emerging or developed, we're looking at public company valuations. So the first thing I want to do with the private company valuation is talk about what's different about private companies. So let's start with a very intuitive question. And this is a question that if you were in my corporate finance class, you kind of know the answer to, but let's put it on the table. Let's say you're comparing two companies. They're in the same business. They have the same financial practices. One is a privately owned company and the other is a publicly traded company. That's the only difference. They're both the same size, same financial, same sector. Which one would you expect to have, if either, a higher cost of equity, and why? How come you want to try? Private company, public company, they're both in the same space, same financials, same size. So size is not an issue. Private company or public company, which one's going to have the higher cost of equity? And what's the reasoning?
I would say privately owned business would have higher cost of
So
business.
put yourself in the shoes of the owner of a privately owned business. What is it about this business? They have the same operations, right? The same business details. What is it that makes you feel you need to earn a higher cost of equity on this business and a stockholder in a publicly traded company?
Yeah, I think the transparency of the information that I put out there versus the
But you're putting out the information, so you're the only consumer of your information. You're trying to fool nobody. So in a sense, so information, you have access to the ultimate. From that perspective, you could argue you're less risky than a public company because you can see all the insides of your business. So it's not the transparency issue. Now, let me ask you a question. Usually, if you're the owner of a private company, you can have most of your wealth tied up in that company. Most private companies, that's true, right? The owner doesn't have the luxury of holding 100 companies. They have all of their money in this one company. You see where I'm going next? If you're an investor in a publicly traded company and bad things happen, you say, you know what, it's going to average out in my portfolio. I've got 100 other stocks. So you tend to be a little more cavalier about risk, right? In other words, you look at only the risk you cannot diversify away. You're owner of a private business. You don't have that luxury. You have a bad year. That is out of your wealth. That's basically your money. So one of the things we're going to talk about today is why the cost of equity and capital at most private companies, I'm going to say most because some this is not true, at most private companies will be higher than the cost of equity and capital at a public company. And then we have to talk about the mechanism that we're going to use to bring that in. Second, one of the issues we've not talked about at all in this class in the context of valuation is liquidity, right? You have a publicly traded company, whether it's Uber or Disney or even a small publicly traded company, there's a price, there's a value. And we said if the price is less than the value, the stock is undervalued. I'll buy the stock. Nowhere in that discussion did I bring in, is this stock lightly traded or heavily traded? What's the float? And you're saying, but practically, shouldn't we care? With a publicly traded company, you know what? It takes care of itself. And here's why. When you have an illiquid publicly traded company, let's say the price says it's 45 in the Wall Street Journal. That's really not true, right? There's no one price. There's a bid-ask spread around the price, which means if you try to buy the stock, you pay a higher price than if you try to sell the stock at exactly the same time. If you have an illiquid stock, and a very illiquid stock at that, what happens is the bid-ask spread tends to be much wider. So when you think your stock is undervalued because it's trading at 45 and the value is 50, and you go to try to buy that stock, you might very quickly say, no, I'm not doing this because the price at which I'm buying is not 45, it's 48. A very liquid stock, 42 might be the price at which you sell for. So the bid-ask spread takes care of our illiquidity concerns. We don't bring it in explicitly into our valuation. In contrast, when we value private businesses, remember why you care about illiquidity. You know, I call illiquidity the cost of buyer's remorse. Have you ever had buyer's remorse? We all have, right? And especially in the context of investing, here's the form it takes. You get all excited with this Coinbase IPO that's happening right now. You take a third of your money and you put it into Coinbase. You know, you've had 3 cappuccinos, you're high on caffeine, maybe a couple of Red Bulls to wash it down. And then 2 hours later, the caffeine high goes away and you say, what the heck have I done? I put a third of my portfolio into this stock that is really, that it's a crypto trading, platform which could go under. The cost of buyer's remorse with a public stock is fairly small, right? Because if you bought the stock at 9:30 in the morning and then you sold it at 3 and not much has happened to the stock between those periods, you might give up on the spread, but it's a fairly small cost. But let's say on your way in today, if you came into school, you stopped at the corner grocery store. In a moment of weakness, you bought the store. Remember, I told you were high on caffeine. Who knows what you do when you're high on caffeine? You bought the store. You've taken half of your wealth and you now own this corner grocery store. You get home and you tell your spouse what you did, or your significant other what you did. And they say, what the hell did you do? Go and sell it. See how much more difficult it is going to be to reverse this transaction. You have to hang out around the store. Do you want to buy a store? How about you? You look like you have a lot of money. With private companies, we need to bring illiquidity explicitly into the analysis because there's no easy way it comes in. So the 2 things you're going to see with private company valuations is, one is this issue of different discount rates and how to bring them in. The second is the illiquidity. And finally, I told you, as the owner of a private business, the peril you face is all of your money is tied up in the business. Let's say you decide to get out of your business. You want to sell your business to somebody else. And I'm going to give you 3 potential buyers. And I want you to rank them from best potential buyer to worst potential buyer and tell me why. So it's same business, and you have 3 buyers. The first is another private individual. The second is a private equity fund that's going to buy this as part of a portfolio. The third is a publicly traded company. Which one, holding all else constant, is likely to offer you the highest price? The publicly traded company, the private equity fund, or another private individual? Naeem, want to try? You look very relaxed, so I'm going to put you on the spot here. So you have a private business you're trying to sell. Who's going to be the best potential buyer in terms of price paid?
My guess would be with another private owner.
Okay. Yossi, you agree?
No, I think a public traded company.
And tell me why.
Finds synergies.
There's synergies, but in addition to that, first, when a publicly traded company looks at my company, they look at only the portion of the risk that cannot be diversified away, because remember, their investors are diversified. They don't care about. So they're willing to accept a lower discount rate because once they buy you, they become part of a publicly traded entity. Second, once a publicly traded company buys an asset, remember, illiquidity ceases to be an issue, because as long as you can trade on the shares of the company, the fact that their assets are illiquid becomes kind of irrelevant. The 2 big issues went away. Your discount rate is no longer higher. There's no illiquidity issue. And if on top of that, you throw in synergies and other benefits, a publicly traded company is going to be a best potential buyer.
Hey, Professor.
Followed, of course, by, I'm sorry, go ahead.
What about, I guess, when you think about how the transaction gets funded, if you have if the private equity fund is, pricing this asset based on what their required return is, and they're able to use a different capital structure or more aggressive financing than the public company, you can see that getting to
Yeah.
the private equity fund
Let
being
me
willing
ask you
to
a
price
question. Do you
it.
think a private equity fund is actually going to settle for a lower return than a public company would accept? Because right now the cost of capital for public companies is about 6%, maybe 7%. Now, I can't think of a single private equity fund that'd be going out there, no matter how they fund it. They could use a lot of leverage, that would accept a rate of return of 6 or 7% as their IRR, right? So when private equity funds use leverage, it's almost entirely to kind of lever up a high return that they think they can make on an investment to begin with. So it's true, you might have a few more degrees of freedom as a private equity fund in terms of using leverage, but I still think a public company is going to be a best potential buyer. A private equity fund, in fact, what private equity funds often do is, when there's no public company on the horizon, they pay a higher price than a private buyer would. And then they create these portfolios that they can then flip to a public company or take public at a much higher price. They're taking advantage of that arbitrage of how much lower the cost of equity and capital is in public markets.
I don't know. I don't think you always see that dynamic exactly in the marketplace though, because I think you've got a lot of private equity funds that are chasing maybe a finite set of firms and maybe the constraints that the public companies.
But the only way to do this is to see if they get into a bidding war with the public company, how often private equity funds win. Sensible private equity funds, you know what they do when they get into bidding war with the public company? They drop out. It's no way to win this game. The good private equity funds tend to go up. So when you get a private equity fund, a public company competing for the same asset, it's very seldom that you see the private equity fund win out on that asset in a direct bidding war. Now, I mean, I'll look up some research because I'm sure there's research that's been done on it. But
if you look at the insurance distribution market, I think you'd probably see a different dynamic there.
I don't know enough about the insurance distribution market, but who are the public insurance companies are the ones bidding against private equity funds, and the private equity funds are winning in that fight? Is it?
Yeah, and so it's a really liquid M&A market. There's 800 deals that get done a year, and 75% of which are going to private equity.
I'll take a look at it, because what I'd be interested in is those deals where you have a private equity and a public company competing for the same asset, because that would be a direct comparison to see what percent of the time the private equity fund wins and what percent of the time, and then following up and seeing what happens to private equity funds which win on those bidding wars and see if they make returns. Because my prior is, if you win against a public company and you buy an asset at a higher price, you're setting yourself up for longer term failure because you paid too much. But I think that's testable. I'll take a look at the business. I don't know enough about the business to respond to that, but in most businesses, when I see these fights, the public company ends up winning the bidding war.
Great, thank you.
So let's now go back to our notes and talk about private company valuation. So the first thing to remember when you value private companies is don't throw away everything we've learned so far. What's the value of an asset? It's the present value of the expected cash flows discounted back at a risk-adjusted discount rate. That doesn't change just because you're doing a private company. And just as with public companies, you have to make a choice. Am I going to value the entire business, or I'm going to value just the equity in the business? But I'll tell you the two problems you're going to run into when you value private businesses that you don't have when you're publicly traded companies. I know at least 3 or 4 people in this class are valuing private businesses, startups, young companies. So help me out here as we go through and tell me whether you've run into the problem. The first problem you're going to run into is when you value a private company, there is no market value out there. No market value, obviously, for the equity, no market value for the debt, there's no rating, none of the crutches we normally use in valuation are available. So that's the first. The second is, if you think accounting standards vary across public companies, you should see what accounting standards look like for really small private businesses, and you will stop complaining. So let's start with the first of those, no market value. Saying, so what? You know how dependent you are on market value when you value a company? I mean, think about the company you valued in your DCF, right? You use market values as inputs. When you did the debt ratio for the company, you used the market cap of the company and the debt. You assumed it was there. But here's the more critical place it came in. After you finished your value and you came up with the value per share, what's the first number you checked it against to make sure you hadn't screwed up big time? You compared it against the market price. Now, whatever you think about the market, having that market price out there is kind of a nice thing to have, because you know when you've got, so if you come up with the value of $10,000 per share and the stock is trading at $10 per share, you know you've missed the unit somewhere, that you added 3 zeros where you shouldn't. So we need market values as inputs. And once we get output, we need a market value to compare it to. And finally, when you think about risk measures like betas, if you use the conventional way of measuring betas and you go to Bloomberg and look up the beta for your company, you're going to have it available only if you're a publicly traded company. So the first thing you're going to run into is the absence of market value is going to create some issues. They're not issues that are going to have to stop you, but you got to deal with them. Second, when you think about cash flows, here are some issues that you probably run into with private companies. Most private companies have shorter histories than public companies. Most, right? There are, of course, startups that have been around only 3 years that are public now. But historically, private companies have historically had shorter histories because you don't have a 150-year-old private company without something unusual happening. Second, we talked about accounting standards. I still remember about a decade ago, somebody in this class decided to value their mother's flower shop as the business. She came to me and said, can I value my mother's flower shop? And I said, be my guest. No. And she came in about 4 weeks later saying she wanted to change companies. And I said, what happened? You have a fight with your mom and you don't want to value a shop? And she said, I went in and asked for her financials. And she took me into a room covered with Post-it notes. Now the mystery mounts, and I said, so? And she said, on one wall, she had pink colored notes, and the other wall, she had green colored notes. And Mom, what is this? And she said, this is my revenue wall. This is my cost wall. At the end of the year, when I have time, I pull the Post-it notes down and I create my financials. I've heard of GAAP, I've heard of IFRS, I've not heard of Post-it note accounting. But with really small private businesses, the owner really doesn't have the time to go through all these. So the accounting might be cash accounting. It might have follow a very different set of rules. The third is with private companies, and this could happen even with small public companies, there is this intermingling of the private with the business. That company van that sits outside the business seems to magically disappear at 3:30 in the afternoon every afternoon when your kids' school's let out. You own the business, you need somebody to pick up the kids, you essentially use the business car. You have an office in your home that you call your business office. But there's a crib set up in the corner of the office, and you might even be cooking food in another corner because, and again, this is not specific to private companies, but with small private companies, it's much more of an issue. And finally, an issue that I've always run into in valuing small private businesses is many private businesses where there's a sole owner. When you look at the financials, you'll notice the sole owner does not pay himself or herself a salary. You see why? You own the business, you get whatever's left over. You say, why would I pay? I own the pizzeria. I'm not going to pay myself a salary. That's silly because I get whatever's left over. But if you decide to buy that pizzeria, you see why this is going to be an issue? This guy spends 18 hours every day in the pizzeria. He's the cook, he's the cleaner-upper, he's the inventory keeper, he's the accountant. He does everything. He doesn't pay himself a salary. He claims to make $200,000 a year. But you buy the pizzeria thinking it makes 200,000. The next day you come and says, who's making the pizzas? They say, nobody, you're supposed to be doing it. So I've never made a pizza in my life. You got to hire somebody to make the pizzas. By the time you do all of that, the 200,000 can become nothing. I always find this interesting on Shark Tank and how many people claim to make money. And then you ask them, do you pay yourself a salary? They say, no, we haven't done that. And they view it as a badge of honor. I don't do that. And the reality is if you don't pay yourself a salary and you're working 15 hours a day, you might claim to make 100,000, but are you really making money? So here's what I'm going to do. I'm going to take you through a private company valuation. And I'm going to argue that with private company valuation, motive matters. Let me explain. About 20 years ago, I remember sitting in my office, and this lady walks in, and she owned a candy company, and she wanted it valued. And she decided that, that I'd be a good person to ask. I don't know why, but then she came in and she said, I want to value the company. And I said, why? And she said, what do you mean why? I said, lots of reasons you want to value private business. One could be curiosity. You built up this business, you want to know how much it's worth. I said, is it curiosity? She said, no. I said, is it for divorce? Because a big reason private businesses get valued is in divorce. You split up, state like California, you get half the value of the property. So it could be what I call show valuations. I mean, there's no money that's going to pass hands, but there's going to be money that emerges as a consequence. She said, no, that's not it either. So I said, are you planning to sell the business? She said, yes. And I said, to whom? She said, you have a lot of questions. I said, I need those answers if I'm running a private business. You could be selling it to another individual. You could be selling it, you could have a partner in the business that you're trying to buy. There's a transaction that comes out of it. I didn't ask her this question because she wasn't a big enough company, but if you're a $100 million private business, I might ask you, are you planning to do an IPO? Is that why you want a valuation? I'm going to argue that when you want to value a private company, you need to know why the valuation is being done in the first place. And it's not just private companies. You're valuing a division of a public company often face exactly the same challenges, right? How much am I going to value this division at? So I'm going to take you through 4 scenarios in private company valuation. I'm going to start with what I think is the richest and the most difficult scenario, a private-to-private transaction. You know what I mean by that? You own a medical practice or a dental practice. When you get older as a dentist or a doctor, you know what you often do? You sell the entire practice to another dentist or another doctor. So private individual to private individual. I'm going to argue these are the toughest private company valuations, private to private. Then I'm going to talk about private to public. You're a doctor with a practice, but rather than selling to another doctor, you sell to a publicly traded medical company that has hundreds of practices bundled up around the country. Things get much simpler then. Third, I want to talk about private companies that are being valued in the context of going public. And finally, we're going to look at this intermediate stop. Rather than going public, you're not quite ready, you're inviting a venture capitalist or a private equity investor in the company, and we're going to talk about the process of valuation. And then that venture capitalist eventually might want to take your company public. But I'm going to look at all 4 scenarios. So let's start with private-to-private transactions. Now, generally, when you have private-to-private transactions, there are 3 core problems that affect evaluation. The first is neither the buyer nor the seller is going to be diversified. Think about it. You're a doctor. You built a practice over the last 30 years. My guess is the bulk of your wealth is tied up in that practice. And the person buying your practice is a young doctor with student loans from medical college. They're going to be almost entirely investors. And neither the buyer nor the seller is going to be diversified, which is going to make a huge issue when we talk about cost of equity and capital. The second is, this is an incredibly liquid investment. It's not easy to cash out. It's not easy to sell off 20%. And the third is, especially in businesses that have a personal component. And it's amazing how many small private businesses, there's a personal component. You run a plumbing business. The reason you have people on your list is because they've used you before and they like you. It's not the name of your company that drives it. And one of the things we're going to talk about is when you sell your business, will people discount the value for the fact that once you leave, much of the business might leave with you? So I'm going to take a very simple example. I'm going to assume that you've been asked to value an upscale French restaurant by the owner who also happens to be this well-regarded chef. So the restaurant's been around for the last 3 years, your financials. The potential buyer is a former investment banker who's sick and tired of that investment banking raise. He's cashed out. He's taken his entire cash and he's going to buy a restaurant. The only problem is this investment banker can't cook a lick. So how you run an upscale French restaurant without being able to cook, we'll have to talk about. But basically, I've given you the facts. The seller of the restaurant is a chef who's built this restaurant. The buyer is an investment banker who's taking his entire wealth and buying the restaurant. And I'm going to give you access for 3 years of data. And the numbers look pretty good. In the most recent year, the company had 1.2 million in revenues and reports 400,000 in pre-tax operating profit, at least based on the financials. Company has no traditional debt, but it does have a lease commitment. And that lease commitment is 120,000 a year for the next 12 years. So they've leased the space in which the restaurant is for the next 12 years. So you want to try to value the restaurant. Let's start by looking at the financials. So these are the 3 years of financials you have. Yeah? Look, 3 years ago, 2 years ago, last year, you can see revenues have grown from 800,000 to 1.1 million, 1.1 to 1.2 million. But then I said, look, last year was a good year, but we've hit capacity. Restaurant, you have a certain amount of seats in there, and that's all you can fill. We're at capacity. So from this point on, your growth is going to be limited. You can't add more seats. You either have to raise prices on the food or just settle into a much lower growth rate. In terms of lease expenses, it's 120,000. The wages have gone up 180 to 200,000. But I need to mention that I don't, as a chef, the chef doesn't charge. He owns a restaurant, so he doesn't pay himself a salary. So bottom line is, with these financials, it looks like the net income has gone from 108,000 to 204,000 to 240,000. Now, obviously, when you look at a private company's accounting, you want to make sure that the accounting actually reflects reality. Let's assume that the person is not pulling off some fraud, that the numbers are what they are, and you're going to use this as your starting point, not your ending point, for your earnings and cash flows. So I'm going to take you through this valuation in 6 steps, where I'm going to start with the discount rates, work to cash flows, and then tie up a bunch of loose ends I have to, because it's a private-to-private transaction. So first, I need a discount rate, and I need cost of equity and a cost of capital. Let's go back to how we've done it so far. When I asked you for the cost of equity for a publicly traded company, the way you did it was you start with the risk-free rate. That's going to stay the same when I do a private company. I'm going to make a currency choice. You had an equity risk premium, which again, you are going to still use. That's the price of risk in the equity market. But with public companies, we use the beta. And you might buy into betas or not buy into betas. But remember the underlying assumption when you use the CAPM or the arbitrage pricing model or any of the risk and return models in finance is the marginal investor is diversified. That's what allows us to focus only on the risk you cannot diversify with. That's already going to raise an issue, because you can see that with private companies, you first can't get these past prices to even run a regression. But even if you were able to, the beta is not going to be a good measure of risk, because the buyer is not going to be diversified. So that's going to be my first stop. What do I do about the fact that I don't have past prices? And what do I do about the fact that the potential buyer is not going to be diversified? Let's start with the easier of those 2 questions. I don't need past prices. I need them for public companies, because remember how I got the beta for any public company? I threw away the regression beta and replaced it with a bottom-up beta. You know what? I can do that for a private business. In fact, I could give you the unlevered beta for restaurants. The only problem is when I look at publicly traded restaurants, you know what I'm going to see there, right? I'm going to see McDonald's and Burger King. The publicly traded restaurants that tend to be mass market, fast food restaurants. You don't get a whole lot of upscale French restaurants there. So you know what I ended up using? I ended up using the betas of high-end retailers, saying, look, the kind of people who shop at Gucci and Tiffany's are the ones most likely to walk into a high-end French restaurant. The unlevered beta is 1.18, and I'm doing that because I'm looking at an upscale French restaurant. You're saying, are you allowed to do this? You're allowed to do whatever you can justify. In this case, I'm arguing that the restaurant beta doesn't capture the risk here because it's more discretionary. So I've got an unlevered beta for this restaurant, but here's the challenge I face. The unlevered beta, or the beta that I can get for a company, captures only the risk you cannot diversify with. Let's do a kind of hypothetical setup. Let's say we're a company with 100 units of total risk. 20 units are macroeconomic, market risk, 80 units are company specific. Beta measures only the market risk. You're saying, why ignoring the other 80 units? The reason I can get away with ignoring them is in a public company valuation, I assume you're diversified. You can get rid of those 80 units by diversifying. But here's the problem with that argument, at least here. When I look at these 20 units of market risk, when I'm a buyer, the investment banker buying the company, he doesn't just see the 20 units, he also sees the 80 units. He's exposed to all risk. I'll tell you what got me started in this. About 30 years ago, I remember I was giving a talk to private company appraisers in a conference. I don't know where it was. I think it was in New Orleans. So 1,000 private appraisers in the room, and we talk, I talk about discount rates. And that time, my experience was primarily with public companies. And I said, no, with public companies, we assume that the firm-specific risk can be diversified away. We use the cost of equity based on the beta. But I know that in most of your transactions, the buyer is not diversified. How do you account for that when you do cost of equity? You know what they said? They said, we take the risk-free rate plus beta times risk premium, just like you tell us to do in every textbook. And then we add an extra 10% that we call a company-specific risk premium. And they said, that's interesting, but why is it 10%? And their answer was, because that's what everybody does. Basically, they just take the intuition makes sense, right? They want a higher cost of equity, but why an extra 10%? In fact, anytime you see these words, company-specific risk premium, trust me, people are just making up crap to get to a higher discount rate. I can see why they're doing it, but there's no basis. And I said, that doesn't work for me. I can't just add 10% to my cost of equity because you tell me everybody does it. I want to come up with the most systematic way of estimating the risk. And they said, good luck. So here's what I did. Remember the place I get my betas is by looking at publicly traded retailers, restaurants, etc., whatever it is, and getting the betas, right? And if you remember the Bloomberg beta page from which I'm getting the beta for each company also has an R squared as one of the pieces of algebra. We kind of glossed over it, but an R squared tells you the percentage of the variance in the stock that is explained by the market. Let me repeat that again. The R squared in that regression tells me the percentage of the variance in a typical restaurant or retailer that is explained by the market. Do you see where I'm going? If I can get betas from these regressions, the unlevered beta is 1.18, I can also get the R squared from these regressions. And because beta is a standard deviation method, if I take the square root of the R squared, which is basically the R, I get a correlation of 0.5. What does that tell me? Based on publicly traded restaurant regressions, here's what I see. I see a beta 1.18. It's an average unlevered beta. But I also see, based on these regressions, that half the risk in a typical restaurant is market risk and half is company specific. I'm ignoring the half that is company specific when I'm looking at a publicly traded restaurant, but I'm going to do a setup an algebra problem. This investment banker is going to have all of his or her wealth tied up in this restaurant. They're going to see all the risk. So rather than see a beta 1.18, I'd expect this banker to see a beta of 2.36, twice the beta. So it's basically the market beta divided by the correlation. Just to do a what if only 25%, the correlation of 0.25 instead of 0.5, my total, I call this a total beta to reflect the fact that it's looking at total risk. The beta here would be 4.72. The more company-specific risk there is, the bigger the difference between a market beta and a total beta. Any questions on what I'm trying to do and where I'm getting the numbers here? Incidentally, if you go to my website under data sets, in addition to reporting betas by sector that some of you might have used in your DCF, I also report total betas by sector. And that's entirely for private company valuation for very small private businesses where the buyer is not diversified. So now I'm getting closer to what I need to do. Pablo?
Sorry, Professor. Thank you. So is it possible to incorporate in your valuation something like that personal factor of
We'll talk
owning...
about that. It's not in the discount rate. Don't do it in the discount rate.
Okay.
It has to be in the cash flows. In fact, we're going to talk about the key person discount. It's what it's called. It actually has a name in private company valuation. I'll talk both about how it's done and how I think it should be done. But you're absolutely right. You have to take a key person into account when you buy a private business. Because otherwise you
Exactly.
buy a business and you basically get a shell, right? You get an office and all your clients have fled. You say, what the heck happened here? That person left with all your clients.
Okay, thank you. Yeah, that's what I was thinking about.
So now I'm getting closer to my cost of equity. So my unlevered beta that I'm going to use is 2.36. I run into a final problem. Remember how I levered up betas for a public company? I got the bottom up beta for the business they were in, and I used a market debt to equity ratio for the company to get a levered beta. There is no market debt to equity ratio for a private company. What people end up doing is using a book debt to equity ratio, but please don't do that. Book debt to equity ratios are worse than nothing because they're kind of meaningless for a private company. So I'm going to make an assumption. I'm going to make an assumption that if I know the market debt to equity ratio of publicly traded companies in a business, if you start a private business, you're kind of bound by the same economics. You're going to use roughly the same amount of debt. It might be an assumption that's not true, especially if you have a company where the private owner refuses to borrow money. But basically here, I am going to use the debt to equity ratio of 14.33% that publicly traded restaurants have, because now I'm looking at the leverage of a restaurant and no longer even look at retailers. So I'm mixing up an unlevered beta for retailers with a debt to equity ratio of restaurants. I get a levered beta of 2.56 and a cost of equity of 14.5%. Just to give you a contrast, the cost of equity would be about 7.5% if I just use a market beta. I'm giving them a much higher cost of equity, kind of addressing that start of the class question of, hey, private companies should have higher cost of equity. Here's where it shows up. I'm going to pause at any questions on total beta and how it plays out in cost of equity.
So what about the leases? Why don't we capitalize the leases?
Oh, we will. When I do the debt, I will. The 14.33% turns out to be pretty close to what if you capitalize leases, you get a dollar value for the debt, but you still need an equity value to get a debt to equity ratio, right? You don't have a market value of equity. So the debt part is not the problem. It's the equity part that becomes the issue. Finally, I bring in a cost of debt. And here again, I draw on a practice I use with public companies. Remember, with public companies that did not have a rating, the way I estimated a cost of debt is with an interest coverage ratio. You're saying that's with a public company. Hey, you're a lender. You care about interest coverage ratios for everybody. It's not private or public. So what I did was I computed the interest coverage ratio for this company based on operating income and interest expense. I don't know whether you remember the lookup table I used. The lookup table gives me a rating of BB+. It's a completely, I know there is no way this restaurant will ever get on the radar to S&P or Moody's to attach a rating, but I'm saying my rating is just a means to an end, BB+, and the default spread was 3.25%. Risk-free rate when I did this was 4.25%, giving me a cost of debt of 7.5%. I used the tax rate of the individual, because this was not going to be incorporated. There's no corporate tax rate, a 40% individual tax rate. And that gives me an after-tax cost of debt of 4.5%. So cost of debt is more conventional. The cost of equity is where you see the big difference. But the net effect of bringing those in is essentially a cost of capital of 13.25%, well above what you'd have seen if this were a public company. So it's a little more work, but not that much. I'm staying within the same framework, just adjusting for the fact that the potential buyer is not diversified. Now here's my next step. I'm going to go up and clean up the financial statements. They're pretty clean to begin with. In some companies, you might have to do more work cleaning up than in others. But here's what cleaning up involved. First, remember how we talked about leases not being operating expenses if they're really financial expenses with public companies? Same logic applies with private companies. I took the lease expenses out of the operating income statement, made them into debt. Second, I recognize my limitations. I'm a banker. I can't cook. I have a pizzeria, in this case, an upscale French restaurant. I'm going to go out and hire a chef. So you got to do your homework and assess how much an upscale French chef will cost. Let's say it's $150,000. That's going to show up as an expense. My operating expenses go up. Now, because I capitalized leases, I now have to, so basically I do the rest of my financials based on that salary. I come up with an operating income of 370,000 and a net income of 180,000. So I'm cleaning up for the fact that the financials don't reflect salaries. If you're valuing really small private businesses, you're going to be spending a lot of time cleaning up for things that should not be there and including things that should be there, because you want to get a sense of what are you truly making at this company. In fact, it's funny because in Asia, when you try to buy a business, you almost never buy it based on the stated financials. You know why, right? The stated financials are what the tax guy sees. And what does the tax guy see? Loss after loss after loss. Every business is a money-losing business. So if you try to buy the business, the first thing the owner will do is he'll take you to an inside room. It's like a bunker room with no windows, make sure there are no listening devices. And he'll say, look, you want to buy the business? Let me show you what the real numbers look like. And he'll pull this ledger book out of the bottom drawer in a hidden compartment. Say, this is what we actually did. Your job just got exponentially more difficult when you have two sets of books. Because who knows whether these are the real books, what he's making up. I mean, after all, he made up all this stuff for the tax guy. How do you know he's not made up this stuff for you as a potential buyer? It's one of the challenges in private company valuation that makes it interesting, because you got to kind of clean up those numbers, go line item by line item, so that does that make sense? And watch out for what I call ghost employees at private companies. These ghost employees will often tend to have the same last name as the owner and often be underage. So you got a 10-year-old as a marketing director. What does your 10-year-old do? Well, he's a marketing director. Well, this might be a way in which, from tax purposes, you're funneling off the income. I call this the George Costanza effect. All the years that I watched the Seinfeld episode, I always wondered what George did for the Yankees. He was the assistant to the assistant equipment manager or something. I don't think I ever saw him do something. I think there was one episode where he replaced the uniforms with polyester. Didn't end well. You saw him talking to the back of George Steinbrenner's head in that particular episode. But there are private companies where you say, what does that guy do? What does that guy do? What does that guy do? You have no idea. They're all on the payroll, and you got to figure out who really belongs and who doesn't. Which brings me to the third step. And this is the question about, hey, what if there's a key person involved? And I'll tell you a story to illustrate how much a key person matters in private company valuation. 4 kids, and they all needed braces. And this is a lucrative business for dentists who deliver it. So all of my kids went through the same dentist. When I took my first kid to this dentist, he was like in his 35. By the time I took my last kid, he was in his 50s. So I got to know him. And so with my youngest kid, and I took him to the dentist. He called me over and I said, "Can I ask you a question?" And I said, "What's your question?" He said, "I'm planning to retire." And I said, "You're like 52. How can you retire?" And he said, "Have you looked at your bills for the last 15 years? That's why I'm retiring, is I've made a lot of money of people like you." I said, "Yeah, that's true." And he said, "I'm trying to value this dental practice." And he showed me the books. I mean, he's actually trusting, and he showed me how much money he made. And I could see how lucrative my kids' braces had been for him. And he said, "You know what do you think I'll get for the business?" And I said, "You've made a lot of money, but there's going to be an issue with somebody paying for this practice based on how much money you made last year." You know what the issue is, right? Let's say I'm a young dentist and I see these books and I say, "You made $1.5 million. I'll pay like $6 million for your practice." I buy the practice, I put myself in the dentist's chair, and my first patient comes in with this child. You know what the first question he's going to ask is, right? "Who the hell are you?" "So I'm your new dentist." "No, you're not." Because this is this is a business where you interacted with a person, not with a business. See, what the worry you have is that if you buy this business and you run the business starting tomorrow, that a big chunk of your revenues could disappear. So take the French restaurant, right? I told you this chef was a well-known chef. Let's say that 30% of the customers coming to the restaurant come for him, not for the name of the restaurant. To value this restaurant, you might have to discount what you see as cash flows because of how much money you think you will lose when the chef leaves. Let's say the chef leaves, that 20% of your customers go with the chef. So your cash flows are going to be lower. In fact, all I did was I took the existing operating income, knocked 20% off. That is a key person discount. So I explained this to Howie. He was the dentist for my kids. And he understood it. He said, yeah, I get it. And I said, you're probably going to lose 30, 35% of what you think is your estimated value because you are a key person. And he said, well, what can I do to reduce that? And you could probably tell him too, what can he do to reduce the impact of this discount? And in fact, you often see this with medical and dental practices when the practice is sold. So here, what can he do to reduce the pain?
Maybe let the company retain his name and maybe recommend
A
the
name won't quite do, right? Because when a 9-year-old comes in and says, I've never seen this guy before, is he going to stick his hands in my mouth? It's more than a name.
let a
He
new
agreed
dentist
to
assist
he
him.
agreed to stay on for a year and a half after he sold the practice. And he didn't do a thing. He just hung around, right? He'd walk with the so basically he created a transition period where by doing it, he reduced the impact. So by the time he actually left, people were comfortable with the dentist who would come in his place. So often you'll see this overlap. And if I'm the dentist buying this practice, you know what I have to make sure that I don't end up doing? If it's a key person issue, if I buy this practice based on income, the last thing I want the seller to do is go next door and start. This is your worst case scenario, right? You buy a practice based on income and the guy moves to the next door, he takes the clients with him. That's why you often get non-compete clauses in private transactions to prevent key persons from coming back and eating up your business. It's part of what you have to deal with private company valuation, but there are things you can do to cushion the impact, like overlapping, staying on. You think, shouldn't this be an issue with public companies too? In some public companies, you can argue it can become an issue, right? I mean, let me ask you a question. What do you think if you did a valuation of Tesla with and without Elon Musk? Do you think the values would be different? I mean, Elon Musk brings all kinds of pluses and minuses to the game. But my guess is he's a net plus, probably worth hundreds of billions of dollars. And because he's made himself central to the company. Part of it is he's built the company. And in fact, that's, I think, a weakness in this model, right? Because if you're a really great founder, what should you try to do? You should try to make yourself dispensable over time. I mean, when I think of, much as I dislike Microsoft as a company, I've got to admire the way Bill Gates managed his transition away from the company. Remember, he left very early in the 1990s. He turned it over to Steve Ballmer, even though he was young enough to keep, and he never interfered in how Microsoft was run. He made sure that Microsoft as a company was not just a front for Bill Gates. When you invest in companies that are driven around personalities, Richard Branson at the Virgin companies, Elon Musk at Tesla, you have to worry about effectively a key person discount, because it's not just that person selling and moving on, but human beings die, they get sick, they go into rehab. When I tell people, what do you think would happen if tomorrow you opened up your news feed and it says Elon Musk goes to rehab? First, would you be surprised? I don't think so. I mean, if I saw that news story, I've been expecting this for a while. But think of the stock price consequence for it, because you built it around a person. Yossi?
Yes, when you value drug companies, they have also kind of drugs and patents that expire in time.
That you can build into cash flows, right? When you value a company, especially if it's a company that gets 60 or 70% of its value from a single drug, a blockbuster drug, Like if you look at statins, for instance, 2013 or 2012, you could argue that a couple of drugs are basically sustaining 50% of the cash flows. Then I think you have an obligation that I think should be brought to the expected cash flows, which means there's going to be a cliff at which your margins are going to drop off when the patents expire. So I think that especially with bigger drug companies, it becomes less of an issue because no single drug ends up being more than 10 or 15%. If a small drug company, no. I mean, can you imagine valuing Moderna with and without the COVID vaccine? I mean, that would be a monumental difference in valuations. So I think we need to this is part of a broader issue. When there's a single factor, a single person that's driving earnings and cash flows, then you got to ask, how sustainable is it? What happens if this goes away? Brandon?
Yeah, do you ever apply any discount for a leader? Potentially Jack Ma could be thought of as
oh yeah, absolutely,
personal
right?
or liability, not really positive.
It could happen, right? And the way you do it is it should already be in your cash flows to begin with, right? Your bad leaders, what do? They do acquisitions in the spur of the moment. They overpay. They have terrible returns on capital. So part of it you've already built in. The big challenge when you have a bad leader is, can we get rid of him? Or can we get rid of her? And that becomes a corporate governance question. If you have a family group company with a bad leader, I would just walk away. Right? That bad leader is entrenched. They're going to stay in place. There's nothing you can do. And if an entire family has the same character deficiencies, best not to even touch the company. But if you have a more traditional company where an activist investor can push for change, then maybe you do two valuations. Remember what the one we did for Hormel, one with the bad leader in place and one with the bad leader deposed and take an expected value. Now, just because you're doing a private company doesn't mean you forget your valuation fundamentals. So I'm going to tie up some loose ends. This company, for instance, I'm going to assume a 2% growth rate in perpetuity. It's about the inflation rate. Why? Remember I said they were at capacity. I don't want to be building new restaurants. This is one restaurant. And in fact, if you don't want to do a perpetuity and say restaurants last for only a period, you might just do it for 10 years. Nothing stops you from doing a finite time period valuation of a private company. In this case, I'm going to assume a 2% growth rate. And just like at any other company, growth doesn't come free. There's got to be some amount you have to put back in the restaurant, the decor, in the kitchen, the amount of so this reinvestment rate is low because I'm expecting a low growth rate. It'd be very different if my objective were to buy this restaurant and make it a franchise, right? Because then it's a very different plan. I'd have to invest in how am I going to expand this? Where are the expansions going? So I've kept things simple because I want to value a single restaurant. But if you have bigger plans, then basically I've got to build that into your growth and reinvestment rate. So I'm ready to finish my valuation. First, I use the key person adjusted operating income. I knock 20% off because the chef is so critical. My cost of capital is a total beta cost of capital. My reinvestment rate reflects my growth rate. The value that I get for the restaurant is about $1.449 million. If you subtract out the present value lease commitments, because remember you treat it as debt. If this chef wanted to know how much I would pay for the restaurant, I'd pay about $521,000. And I will wager he's going to be disappointed, right? Because remember, the restaurant is making $180,000. You're saying, you're paying me only 3 times net income. Well, that's what happens when you have total betas. Your cost of equity and capital get pushed up. A mature private company being bought by an individual who's not diversified will trade at far lower multiples of earnings or revenues or any other metric than an equivalent public company because you factored in those costs. Kushal?
Professor, is there a need to look at return on capital for a private company in any different way than we do for public companies?
No, exactly the same way, because it's an accounting number, right? It's private, public. The one thing that you might have to be aware about, remember I said it's an accounting number. The more screwed up the accounting, the more difficult it's going to be to nail down the number. Remember the posted accounting company? I'd have a really tough time telling you what the return on capital is of the company because the accounting has been probably sloppy for a decade. The more sloppy the accounting, the more cleaning up you have to do to get to a return on capital. But it's just an extension of what you'd have done at a public company. David?
Yeah, I know this is a bit circular, but so the debt to equity, if you look at the actual numbers at the end, is like much different than what we used, right?
Yeah, that's David's point is an excellent point, which is, you remember I did that when I did my levered weight and cost of capital, I used, and Yossi, I think, brought up the same issue, which is 14.33% debt. And the point you're raising is if I look at the debt as a percentage of equity, if I use the 521, my debt to equity ratio is closer to 180%. Is there a I mean, it's a classic problem in valuation that when you do cost of capital, but is there a way I can, if let's say that is really bothering me, that I have a very different debt ratio that I've used in my beta calculation and from what I'm getting. Is there a way I can fix that? What could I do, David?
Yeah, I was wondering if you could use pricing to get to a debt to equity ratio.
Or why can't I use my estimated values of debt and equity as my debt to equity ratio of the levered beta? It creates a circularity. But if you check the iteration box in Excel, you can actually do that. With private company valuations, I often do that because you're absolutely right. I made up this industry average debt ratio, and then I'm telling at the end I was wrong. Just use the iteration box. Make sure, because if you don't check the iteration box, all heck will break loose in your Excel spreadsheet. And then you will get internal consistency. In this case, it actually moved my value by not that much, 5% when I said it, because the effect kind of, things got, I had a higher beta, but I also had a higher debt ratio. My overall cost of capital didn't change that much. But it's a good point to bring up is you need that internal consistency in a private company. And here you don't have the excuse of saying that's my transaction price, right? With a public company, the reason we use market values is not because they're right, but because that's what you have to pay. Here you don't have that excuse. So there's a much greater rationale for using that iterative process. Which brings me to the final step. So I've come up with the value of 521,000. I get ready to pay it. And then I remember this cost of buyer's remorse. What if I screwed up? And I'll tell you that this is something, if you've ever worked in private company appraisal, that is a big number. In fact, in typical private company valuation, here's what appraisers will do. They'll value the company and the equity. They'll knock off 20% or 25%. You say, why do you do that? It's an illiquidity discount. And remember what we said about bias very early in this class? A lot of private company appraisers are valuing businesses for tax purposes and divorce court purposes. Their end game is they want to get the lowest number they can. So guess what? They want to make this discount a really big number. But it's what was always, rather than even take issue with the 25%, here's my question. Why is it always 25%? Why is it this fixed number? Because here's what I would expect. I would expect it to be smaller for healthier money-making companies than companies losing money. I'd expect the discount to be smaller. I'd expect the discount to be smaller when the market is doing well and the economy is doing well than if you're in the middle of a crisis. If I'd been trying to sell my business in November of 2008 or March of 2020, I'd expect the discount to be much bigger for illiquidity. And I'd expect the discount to actually vary across buyers. Do you see why? Some buyers have lots of cash. They don't care about liquidity. Some buyers care a lot. And this is why liquidity discount will always be this unmoored number, because it's going to depend on the company, the timing, and the potential buyer. There's going to be no one approach that works. But I'll give you at least the basis for the standard approach. The basis for the standard approach, where you apply a 20 to 25% discount, came from two sets of studies. One set of studies looked at stocks called restricted stock. You're saying, what are restricted stocks? These are stocks with restrictions on trading. They're publicly traded companies, but they're actually issued to the market, but you're not allowed to trade the stock for a year or two. So there are companies, publicly traded companies, that make restricted stock issues. You see the advantage of having a restricted stock issue then, because you can see the price people are paying for those restricted shares and compare it to the market price. That difference is the discount they're attaching because you can't trade. The second set of studies are a little shakier. They look at transactions that happen on shares in companies that are on the verge of going public. They look at the 3 months or 6 months before. They look at the prices people get for their shares and compare to the IPO price. So whenever you want to observe illiquidity discounts, it's got to be on something where you can observe the market price. And these were two obvious scenarios. And in both cases, the discounts from the studies have tended to be very large, 25, 30, 40. And I'll be quite honest, I don't trust any of these studies. You know who does them? People hired by private company appraisers do the research. And not surprisingly, they feed into private company appraisers. You can discount 40% here. There's a study to back you up. So in both cases, the discount is obtained by looking at that difference. So let me take a closer look at these studies. Okay. Here's how restricted stock works. You're a publicly traded company. Normally, if you want to raise fresh equity, you got to go through the SEC approval process, right? Basically, you got to file a prospectus. It's time involved and involves money. And if you're a troubled publicly traded company, the keyword is trouble, you don't want to go through the process. You want to raise capital on the sly, and there is an opening the SEC allows where it says, look, you can issue shares without a prospectus, but the shares that are issued under this special clause cannot be traded. It used to be 2 years from the time people buy the shares. So that's a trade-off. You can issue these shares without the process, but the people buying these shares cannot trade them for 2 years. Now it's 1 year. And these go back to the 1970s, but many of the early studies of restricted stock found discounts at 30, 35, even 40% on these shares. People are demanding a huge discount. And that's what in the 1970s and the 80s was the basis for this huge discount that people were paying. In the 1980s, Bill Silber, who, and many of you, he doesn't teach foundations of finance, but it used to be one of the rituals. If anybody went through NYU business school, Bill taught them for almost 40 years. And Bill Silber used to laugh because he did a lot of research, but the paper that he wrote that was quoted the most was a throwaway paper, a paper he wrote over the course of a summer looking at restricted stock issuances. And he did something very sensible. He said, why is it reporting the average discount across all restricted stock? You have like 50 or 75 restricted stock issues. Some have 20, some have 50, some have 15. He decided to take a closer look at why the discounts varied across different companies. And here's what he found. He found that bigger companies had smaller discounts than smaller companies, which kind of makes sense, right? If you're a small company, you're trying to make a restricted stock issue, the discount tends to be bigger. He found that the larger the restricted stock block was, the bigger the discount. Again, that makes sense. You're putting a big block, discount will be larger. He found that money-making companies had much smaller discounts than money-losing companies, which again feeds into intuition. And finally, he was looking to see whether there's any hanky-panky going on under the numbers, saying, was it a customer or a supplier buying the restricted stock? Because maybe there's a quid pro quo where they pay a higher price, but then get a lower price, some other benefits from the company. And he ended up with this regression. Say, what the heck are you going to do with that regression? Nothing that mind-boggling, but that regression tells me that discounts vary across companies. Bigger companies have smaller discounts than smaller companies. Money-making companies have smaller discounts than money-losing companies. So here's what I did. I took the standard that people are applying. I said, okay, you want to use the 25% average across all IPOs. I'll start with that number. But here's what I'm going to do. I'm going to take the Silber regression, which tells me how much the discount should be different for money-making and money-losing companies. So if you're wondering why I have two columns, the yellow column is what the discount would be for a money-losing company. The purple column is the discount for a money-making company. So money-making companies have smaller discounts than money-losing companies. And I also looked at what the discount would be based on the revenues here, because remember in the regression I had a log of revenues. If you're $1 billion company that's making money, your discount based on that regression could be about 15%. But if you're a money-losing company with $1 billion, your discount should be 26%. If you're a company with 5 million in revenues and you're money-losing, the discount would be 35%. It's a quick and dirty way of adjusting the discount across companies based on the size of the company. But it all comes from one study in the 1980s. About 20 years ago, you started to see the other set of studies, IPO discounts. And here the discounts are so mind-bogglingly large, I don't believe them for a second. These studies consistently find Remember, these are the prices people are accepting before an IPO, and the 3 months before an IPO. So Uber is going to go public 3 months from now. You own shares in Uber, you try to sell the shares. Well, you know what these studies find? That typically people sell their shares at a 40% to 50% discount on the IPO price. Let me ask you a question. You own shares in Roblox, or you own shares in Coinbase. Would you sell these shares at a 40% discount? You're saying you can't wait for 2 months, you're charging a 40% discount? This can't just be liquidity, right? This discount has to capture other uncertainties. What other uncertainties? Do all companies that plan to go public go public? Well, look at Ant Financial. Not all IPO transactions go through. In fact, the fundamental problem with both the restricted stock and the IPO studies is this bias. And here's the bias. Typically, companies that use restricted stock tend to be basket case companies, trouble companies, small companies, companies that can't raise capital. So what you see as a discount is not just for illiquidity, it's for the selection bias. These are trouble companies. Typically, people who sell their shares before an IPO are not doing it before a healthy IPO. They're doing it because they're concerned that the IPO will not go through. It's a classic statistical problem, right? And here's what has changed until probably 20 years ago. Remember, many of these fights happen in court, where a private company owner would hire an appraiser, an expert witness, to come in and say the illiquidity discount is 30%. And the IRS was a cheapskate. They wouldn't even hire experts. And basically, the 30% became the default. About 20 years ago, the IRS decided to finally spend some money to push back. They hired a statistics expert who basically came in and pointed out the bias and actually was explicit. He said this 30% discount you're seeing on restricted stock, only 10% is because of illiquidity, 20% is because of the sampling bias. I still remember when that happened and the court actually agreed. It was, private company appraisers actually went crazy. They said, no, this has changed the rules of the game. But basically it was bringing some realism to this process, which is these discounts were based on something that really was a very shaky number. So I don't trust these restricted stock studies. I don't trust these IPO studies. You're saying, what are you going to use instead? I'm going to use a much larger sample of illiquidity. Remember I said with a publicly traded company, there is illiquidity is a continuum. It's not that private companies are illiquid and public companies are liquid. The amount of liquidity varies even across private companies. You buy a small, lightly traded NASDAQ stock, you face a lot more illiquidity than when you buy one of the FANG stocks. And I said the bid-ask spread actually measures the amount of illiquidity. So about 20 years ago, I decided to look across all publicly traded stocks to see why that illiquidity discount varied across companies. So my sample now is all stocks. And here's what I looked at. I looked at the bid-ask spread as a percentage of the price. So if your spread is 20 cents and your stock price is $2, 20 cents divided by $2 is 10%. And I ran a regression very similar to the silver regression now across all stocks. Higher revenue companies were more liquid than lower revenue companies. Companies making money were more liquid than companies losing money. Companies with a lot of cash were more liquid than companies without the cash. And companies with a lot of trading volume had much lower liquidity discounts, much lower spreads. I now have a regression across all publicly traded stocks. You're saying you're looking at private businesses. If I take this case, a restaurant, can I look up its revenues the most recent year? Absolutely. The fact that it's a private company doesn't stop me. Can I tell whether it's making money? Yes, I have the financial statements. Can I tell how much cash they have? Absolutely. You're saying, but you don't have a trading volume. Yes, I do. It doesn't trade at all. Think of it as a public company that doesn't trade. I plug the numbers for the restaurant into this regression, and I got a predicted spread of about 12.88%. If this restaurant were a publicly traded company with these characteristics, its bid-ask spread would be 12.88%. That became my discount. So if you think about my choices here, if I use the bludgeon approach, which is the way I describe private company, what a private company appraisers do, I'm going to knock 25% of the value for every company. If I refine it for the silver adjustment, I get a slightly higher discount because it's a pretty small company. And if I use the bid-ask spread approach, I get a much smaller discount because it's a money-making company, it's a healthy company, and the value that I get is $454,000. So let's review the 6 steps. When you think about it, you start by getting the discount rate. The adjustment there is the buyer is not diversified, so I'm going to allow for a higher beta, higher cost of equity. Second, you adjust the cash flows for all the standard things. Make sure you clean up, make sure you have a salary. Third step, if there's a key person involved, this is your last chance to deal with discounting the income for the loss of that key person. Fourth step, reinvest enough to sustain whatever growth plans you have for this private business. Fifth step, value the business. And sixth step, clear up for illiquidity. And again, as I said, that will vary across time, across companies, and across potential buyers. Any questions on private to private transactions? So this Thanksgiving, you could be very popular at home with your family because any of you in private business, you can offer your services for free. It's not a good idea. Don't do it. You can only get paid from doing this. But you know how to value private businesses now. It's not rocket science. It does mean with every time I value a private business, I find myself talking more to the owner than I would with a public company because there are things I need to ask the owner directly. Because that's the only way I can get an answer to, should I be building that into my numbers? But don't throw away, don't abandon everything you've done in valuation just because you're doing a private company valuation. Let's talk about private companies being sold to publicly traded companies. I know we've done a lot, but this is the easy scenario. You're a private company, you're approached by a publicly traded company. It says, we're interested in buying you. Remember first, you now have to think about risk through the eyes of the investors in that public company. And investors in public companies are diversified. So you can go back to using a market beta. So that's the first advantage. Second, once this company becomes part of a public company, you can stop worrying about illiquidity. So here's what I did. I took the restaurant and I valued it as if a public company were my buyer. So first thing that changes is I go back to a market beta. So my beta goes back to 1.18. I still use a debt to equity ratio of the industry, 14.33%. But notice my cost of equity is much lower. My cost of capital is much lower. So the first and biggest change when it's a public company buying buying my business rather than a private, it's a much lower cost of capital. When I did my ultimate valuation, remember the valuation I got as a private company with a 12.88% discount was $453,000. With a public company, the two things that change is I still have a key person discount. A public company still has to worry about it, but I don't have an illiquidity discount because this, once it's part of a public company, you don't have to worry about liquidity anymore. Remember I said the best potential buyer for your private business is a public company. It comes primarily from the difference in discount rates and the difference in liquidity discounts. Yossi brought up the interesting question of what if there are synergies? I hate to be cynical, but if there are synergies, guess who's usually going to claim them? The public company is going to say, it's none of your, this is not you, this is us. Now, of course, you can try to negotiate. The only way to get a share of things like synergy is by getting a second public buyer interested in you. If you can get 2 public buyers interested in you, then your power increases. Because even with this scenario, you can see that you're unlikely to get, if a public company is the buyer, you're unlikely to get the 1,483, 1.48 million. Public companies probably, if you're lucky, pay you 600, 700,000, which is better than what a private buyer would have. But there's, we're going to talk about M&A and we're going to talk about and generally it's been a horror story. Acquisitions have destroyed more value than any other single corporate action in history. But the one good news story in acquisitions is when you acquire privately held businesses. And the reason you get an advantage is you can pay more than what the private owner thinks he or she can get, but less than what it's worth to you, and you claim the difference. It's a value added you get from doing pretty much nothing, doing risk arbitrage, because your investors are diversified. So you can go out and ask for the 1.484 million, But my guess is you're going to end up somewhere in the middle, and where you end up will depend on your bargaining power. And if you have enough, if you have more than one public buyer, then that 1.484 million might become more realistic. So any questions about private versus public company valuation? Kushal?
Yeah, sorry, I'm a little confused why we use, like why the beta goes back to market beta, and because doesn't that still need to incorporate the risk of the investment, which is still the private company in this case?
No, because the investor is now the investor in the public company owns the private business. So the private company owner is now gone, right? You know, the risk is always through the eyes of the buyer. It's not through the eyes of the seller, because the buyer is the one who's going to incorporate that investment. So if you're a public company, you buy a private business, it becomes part of the public company. You got to look at the risk in that business through the eyes of investors in your company. And your investors are diversified investors. So that's the magic of a public company being able to do things, is they can be much more sloppy about risk because their investors are diversified. In fact, later when we talk about PE investors fall somewhere between the completely undiversified owner and the investor in a public company. They're not as diversified as the investor in a public company because they still have holdings in a couple of sectors. But the advantage of being an investor in a public company is you're diversified, then your capital can be employed using a much lower discount rate. I'm going to stop there. When we start on, again, reminder that there's no class on Monday. When we start on Wednesday, I'm going to wrap up private company valuation fairly quickly because the last few loose ends I was talking about valuing IPOs. But if you can, or forget if you can, please do download the last packet, which is already online, and bring it with you, because we're going to start talking about options on Wednesday. And if your option pricing is rusty, don't worry. Wednesday will be kind of a speedy review of the basics of option pricing. So if all you remember about Black and Scholes is their names, don't worry. By next Wednesday, I'll give you a little more intuition that you can use to hang on to option pricing. But next Wednesday, we're going to start on real options. So I will see you next Wednesday.